Welcome to the Byte-Size Brief. It is April 23rd, 2026, and today we are putting Avis Budget Group, and that's CAR, completely under the microscope. Let's just, get right into it.
Yeah, let's do it. We've got a massive stack of intel to go through for this deep dive today.
We really do. And, I have to set the stakes here because CAR stock has experienced just this unbelievable 400% surge in literally just 6 weeks.
Right, hitting a new 52-week high of $520.69.
Which is just wild. So the mission today is to cut through the noise of this massive rally and figure out what is actually happening beneath the hood of this rental giant.
Exactly. And to do that, we're pulling from, a pretty wide range of sources. We've got their recent Q4 2025 SEC filings, some fresh Barclays analyst notes.
Oh, that Barclays note is spicy. We'll definitely get to that.
Oh, yeah. Plus, we're looking at their multi-year strategic press releases, specifically regarding Waymo and just some raw, on-the-ground customer sentiment from Reddit and travel forums.
Right, because you have to look at the massive stock chart movement, but then you also have to figure out why this is happening right now. Like what is the actual reality versus the market mechanics?
Right, and that's the disconnect, isn't it? Breaking down this 400% stock rally. I mean, the share price is completely detached from the company's actual daily operations right now.
Totally. So break it down for us. What are the mechanics here?
Well, look, this is a textbook short squeeze, just pure, unadulterated market mechanics. You've got massive short interest. I mean, at times recently, it was nearing 100% of the public float.
Wait, 100%. So literally almost every available share was bet against.
Pretty much. And you combine that with this incredibly high ownership concentration. Just two entities hold 71% of CAR.
Wow. So there's basically no supply.
Right. No supply, massive short interest. And then you add the recent geopolitical tensions that spiked oil prices.
Oh, right. Because when jet fuel gets too expensive, flights get crazy expensive. And people just decide to drive instead.
Exactly. Historically, that pushes travelers toward car rentals. And then you pile on the recent widespread airport and TSA disruptions, which leaves people stranded and desperate for rental cars. You put all that together, and it's just a recipe for a massive volatility-driven surge.
So basically, it's kind of like a coiled spring snapping back because short sellers are forced to buy, not because the company suddenly sold 400% more rental cars.
That is exactly what it is. The buying is forced, not fundamental.
Okay, but hold on. How does that actually affect Avis Budget Group, CAR's stock price, for regular investors like me who might be looking at this and thinking about buying in at the top?
Well, that is where the severe risks come in. And this is exactly what Barclays was pointing out in their recent downgrade.
Right, they downgraded them to a sell, didn't they?
Yeah, an underweight or sell rating. Because they cited, quote, unjustifiable valuations. They're explicitly saying that this rally from $100 to nearly $500 is entirely detached from the fundamentals. They did. And that's the crucial nuance. They raised their fundamental price target to $150.
That feels so contradictory, though. Like, how do you tell people to sell, but also say the company's worth more than you previously thought?
Because they're saying, look, the actual business is doing a bit better, so it's realistically worth $150. But because it's trading at $500 due to a mechanical squeeze, you have to get out. It's a massive premium.
Got it. Gravity always wins eventually. So if the stock price is just this technical market anomaly right now, our listeners really need to know what the actual business is doing. Okay, so compared to last quarter, what actually moved the needle here?
Well, let's look at the Q4 2025 earnings report. And frankly, the top line is pretty stagnant. Revenue was $2.66 billion.
Which is what, basically flat?
Actually down about 1.7% from the previous period. And we saw demand softening, too. Rental days were down 1%, and revenue per day was down 2%.
So they're renting fewer cars and making less money on the ones they do rent? Not great.
No, not great. But that's not even the biggest issue. The massive deterioration here is this $518 million impairment charge they took in Q4.
Wait, $500 million?
Yeah.
In one quarter. What was that for?
It was specifically to write down the fair value of their U.S. EV, electric vehicle rental fleet.
Oh, wow.
Yeah, they basically had to shorten the useful life of those EVs on their balance sheet because the resale value of electric vehicles has just plummeted.
Wait, they are taking a $500 million hit just because their EVs are losing value? How does a company with an $889 million annual net loss justify a $16 billion market cap right now?
I mean, fundamentally they don't. But to be fair to the management team, despite that massive EV hit, the bottom line technically did improve compared to the disaster of the previous year.
Right, because last year was a bloodbath.
Right, huge bloodbath. The net loss for this recent quarter narrowed to $747 million, which sounds terrible, but
compared to last year.
right, down from a massive $1.958 billion loss previous.
$2 billion.
Yeah, and that prior loss included a $2.3 billion fleet rotation hit. So the bleeding has slowed. In fact, their adjusted EBITDA in Q4 actually moved into positive territory at $5 million.
Wait, positive $5 million? Up from what?
Up from a $101 million loss. So on a purely operational level, if you strip out the crazy accounting charges, they are technically doing slightly better.
Okay, but still, a $500 million write-down is brutal. Management has to know their balance sheet is totally stressed.
Oh, they absolutely know, which is exactly why they are making massive corporate moves right now to capitalize on this short squeeze craze.
I mean, you have to, right? If the market hands you a 400% premium, you take advantage of it. So what are they doing?
Two big things. First, they just issued $965 million in asset-backed securities to refinance their fleet funding.
Okay, standard debt restructuring.
Right. But the second move is the big one. They launched a 5 million share at the market, or ATM, equity program.
Wait a second. So they're issuing 5 million new shares at these elevated squeeze prices. Isn't that watering down the stock and diluting the everyday shareholders who are holding the bag?
Yes, it is absolute dilution.
That is brutal for the retail guys buying in right now.
It is, but from a corporate survival standpoint, it's a necessary, really cold-blooded financial maneuver. I mean, they have to pay down this massive debt.
How much debt are we talking?
Over $19 billion under their vehicle programs, plus another $6 billion in corporate debt.
Jeez. $25 billion total. Yeah, you sell shares if they're trading $500. No brainer. But, surviving isn't the same as growing. Why are some institutional investors still so bullish on them?
Well, that ties into their long-term narrative. They're trying to pivot into a tech mobility platform, and the core of that bull case is their new multi-year strategic partnership with Waymo.
Okay, the robo-taxis. I've seen the press releases.
Right. CAR is serving as the fleet operations partner for Waymo's fully autonomous ride-hailing launch in Dallas, which is coming by 2026.
So they're going to be managing the self-driving cars.
Exactly. The narrative goal they are pushing is to reach $12.2 billion in revenue by 2028 by moving beyond just traditional rentals.
Right, but what does all that actually mean for Avis Budget Group, CAR investors? Does managing robo-taxis actually make them profitable?
Well, the theory is that B2B fleet management, like cleaning the cars, charging them, fixing tires for Waymo, strips out the massive overhead of dealing with individual angry consumers at an airport counter. It's supposed to save their margins.
I mean, promising a high-tech robotic future is great for a press release. But what about the actual people renting cars today? Because you mentioned angry consumers, and from what I've seen, it is rough out there right now.
It is incredibly rough. The customer disconnect on the ground is stark. You've got this high-flying stock price and all this futuristic Waymo PR, but the reality for travelers is brutal.
Tell me about it. What do the sources say?
Well, pulling from travel forums and Reddit now, to be fair, YouTube reviewers note that CAR is generally decent for business travelers who have top-tier loyalty perks at airports. If you can skip the line, it's fine.
Yeah. If you're a VIP, you get VIP treatment.
Yeah.
But what about everyone else?
Everyday consumer sentiment is currently toxic.
Give me some examples. Like how toxic?
We're seeing specific horror stories. Customers waiting 2.5 hours in the heat only to finally get to the counter and find out their reserved cars were overbooked.
Oh, that's the worst. You have a reservation and they just don't have a car.
Exactly. And it gets worse. People are getting hit with bogus $450 cleaning fees weeks after returning the car.
Wait, $450 just automatically charged to their cards.
Yep. Plus stories of key fobs breaking mid-trip, leaving renters completely stranded on the side of the road with no support. But the craziest part...
Oh, there's more.
Oh, yeah. One of the sources, someone claiming to be a former operational manager, cited that the company is allegedly still using insecure contract processing software from 1972.
Wait, 1972?
Yeah. And they said the employees are out in the lots using these ancient Java-programmed handheld scanners that constantly overheat and crash in the sun.
You have got to be kidding me.
And because of that tech debt plus high employee turnover, they rely heavily on contract labor, which just leads to systemic operational failures.
Okay, if I'm a retail investor looking at CAR, I have to ask, How long can a business survive if the actual customers feel like they're being scammed by 1970s software and bogus fees? Like, wouldn't people just leave?
You would think so, but you have to remember the structure of the broader industry. It's basically a duopoly or oligopoly.
Right, it's just them, Enterprise, and Hertz.
Exactly. We're just using peers like Enterprise or Hertz as a benchmark here. But the point is, consumer choice is incredibly limited.
So even if you hate your experience, where else are you going to go?
Right. That captive market insulates CAR's revenue to some degree. You might be furious, but next time you fly into Dallas, you're still choosing between the same three counters.
Man, that is just a wild dynamic. Okay, we've covered a lot of ground today. Let's try to synthesize this deep dive. Because on one hand, Avis Budget Group, CAR, is this spectacular market phenomenon, right? It's a coiled spring of a short squeeze driving the stock to the absolute moon.
Yeah, completely disconnected from the balance sheet.
Exactly. But then on the other hand, it's a company with negative equity, $500 million EV write-downs, angry retail customers dealing with scanners from the 70s, and management making this desperate pivot to autonomous fleet management just to save its margins.
It's two completely different realities. But, there's a broader implication here that I think listeners should really chew on.
Oh, what's that?
Well, think about that Waymo pivot. If Avis successfully transitions into the operational backbone for autonomous networks, will traditional human customer service metrics even matter in a decade?
Oh, wow. Like if they don't have to deal with retail customers at all.
Exactly.
Yeah.
Will CAR simply become a faceless, highly profitable B2B fleet manager where their consumer reputation just becomes irrelevant?
That is a fascinating thought. Are they just going to completely abandon the consumer counter altogether?
Well, all right, listeners. What is your take on the future of Avis Budget Group, CAR? Are you bullish on the Waymo pivot? Are you bearish on that massive mountain of debt? Or are you just sitting on the fence waiting for the short squeeze to end? Let us know in the comments.
Yeah, we'd love to hear your thoughts on this one.
Absolutely. See you next time on the Bite-Size Brief.